Good morning, everyone. I hope everyone's okay and enjoying the weather. If everyone's got tickets for Oasis, if there's any spare, feel free to give us a call. I was nearly late to the webinar trying to get a couple. So welcome to Pareto's quarterly market update in conjunction with Lunar Investment Management. And as usual, we'll be discussing the financial trends and market developments that's affected investments, particularly over the last quarter, looking forward and how that's affected some clients' portfolios. We'll be sharing our perspectives on the current market conditions, investment strategies, and impact on clients' plans. For regular listeners, we have Alex Brandreth, Chief Investment Officer at Lunar Investment Management, who's responsible for coordinating the investment strategy at Lunar. We also have Chris Issac, Chartered Financial Advisor at Pareto, who sits on Pareto's Investment Policy Committee. Chris specialises in advising individuals and owners who manage businesses in various aspects of financial planning and will offer a view on the markets from an advisor perspective. In the webinar today, we'll be concentrating on the Labour government and 1 year on, how they've affected the UK economy, the impact of tariffs on economies and markets, and tariffs raised, it said yesterday, with Donald Trump saying that he wasn't going to implement any more tariffs, then changing his mind with the potential 50% on Brazil. And volatility is normal in the markets, and it's nothing to worry about. Volatility can be your best friend or your worst enemy, depending upon how you react to it, and how markets tend to deliver attractive returns after crises. I'll reiterate, as I do in all of our presentations, please be mindful to review your underlying investments to ensure they reflect your risk and volatility profile. Obviously, we do that at regular reviews with our clients, and feel free to speak to your advisor and review that, particularly pertinent when markets are volatile. Just before we start, some housekeeping. To mitigate background noise, can we please make sure that we're all on mute? The presentation is being recorded and will be available online and through other various channels. And the presentation should last around about 40 minutes with the Q&A at the end. Questions can be asked via the Q&A button at the bottom of the Zoom screen. So, without further ado, Alex, with regards to the markets and the Labour government that we mentioned before, Labour have been in for just over 1 year. We've had the autumn budget and spring statement. So can you just tell us how that's impacted on clients' portfolios, please?
Yeah, I mean, probably worth stop sharing your screen. That's the only thing I said at the beginning. So let's talk about the UK. You're right, we're a year in charge now. So what's the impact been? The first thing I'd say is the key development over the last year has been the budget. The budget has impacted economic growth within the UK. It's added to inflation in the UK. It's negatively had an impact on the employment market. So let's just go through a few of those things to begin with. Economic growth's been weak. I mean, we've just had a reading this morning from May showing the economy contracted again. And I think the economy's grown about 1% over the last year since Labour have been in charge. The first quarter was actually pretty strong. The second quarter has been weaker. The second quarter has been weaker because of the impact of the budget coming through and national insurance going up. And I'll touch on the employment market in a second. Again, the budget meant that national insurance going up meant that everyone increased their prices. So that's led to inflation picking up to 3.3% in the UK, which is, I mean, go back 3 years ago, it's not back to the levels of 10, 11% that we saw when Russia invaded the Ukraine, but it's still above the 2% Bank of England target. So I think from both perspectives, the government will probably be a little bit disappointed on both those measures because one, economic growth's weaker and inflation's stickier. The employment market, I think the legislation that's been brought in of day one rights and national insurance contribution, you've seen the number of people being employed start to fall and job vacancies reduce as well. And that's not really good for the economy either because the economy, we're a service-based economy, so you want people in work to be able to do it. So it's not been great. I'm going to share one slide, which is just UK finances, because this is really coming in after the U-turns that we've seen from the government more recently on the budget. And Rachel Reeves has kind of backed herself into a corner a little bit in terms of her own fiscal rules. And I think that's why the budget is going to be really important in the next budget. So, and it's not beautiful. It's probably one of the scariest charts you'll see. And apologies for if this is a bit depressing, but this is the reality of the situation that we're in the UK. That's spending going forward through, it goes out to 2070. So probably these are estimates, take into account economic growth, etc. But you can see revenue starting to decline. And there's a couple of reasons why that's happening. The first is we've got an aging population. As you have an aging population, there's going to be less people working. So that means that revenue is not going to continue to go up. But as people get older, they need to spend more on healthcare. And with the NHS, we're going to be spending more on healthcare over the coming years. One of the other big developments this year, apart what Trump's put on the world, is that the US isn't going to be the defender of the world. And that's seeing everyone increase defence spending. And that's going to be a big increase. So a few months ago, we said we were going to increase defence spending from 2% to 3% of GDP per annum. That's now, according to NATO, going to 5%. So that's another 2% of GDP every year, which is going to have to be funded to go and support Ukraine and other efforts for defence spending as well. That's a big increase. So it's not a pretty picture, and we come back down to the changes more recently in terms of the rollback on welfare. You did see the UK bond market sell off because they're worried about UK finances. We have a lot of debt, and these fiscal rules have really put Rachel Reeves into a bit of a corner. So we're a bit stuck in that regard. So it's not great. Economic growth as well keeps undershooting the OBR budget guidance, which means that it just means it's getting harder and harder to fund that gap. So October is going to be interesting. Back to how the markets have behaved. Equity markets actually been okay. Bond markets, as I said, has been orderly. I think with this weak growth that you're seeing as well, you'll probably see more interest rate cuts, which will be supportive for the bond market. So it's not been a disastrous year. It's not been the best year. It's just been a bit in between, I'd say.
So bearing in mind, you mentioned inflation, interest rates, possibly coming down a little bit. Markets, there's still opportunities without being Machiavellian about things. You mentioned about the UK, Germany, probably most of the NATO countries having to increase their defence spending. There will be opportunities going forward. So, Chris, what do you think clients should be thinking about with regards to their portfolios if they've got money in the bank that is going to get less going forward?
Yeah, I think that's definitely a conversation we're having more with clients at the moment around, you're seeing it out there with your best savings rates starting to creep down. And I think a lot of it's a mental thing. You can still kind of get cash rates starting with a 4, but as soon as I think that gets down into the 3 range, that often seems to be a bit of a trigger.
But also take off the tax.
And factoring in tax as well. And I think that's where, often then people, yes, they've been comfortable in cash and it gives them that veil of safety, but then that's the time when often they start to look for something a bit with a bit more growth on it. But I think it's, as Alex said, it's been an interesting year to say the least. I think when Labour came in, it felt like they had a good opportunity. I think regardless of your political views, I think everyone agreed that the Conservatives, had their time and it was probably time for a fresh start. But and actually growth was kind of overperforming at the time that they came in, and inflation was coming down, and you felt there was an opportunity there. And then obviously the budget came out, and we don't need to go over that again, but it really seemed to suck the air out of the economy a bit, I think. And as Alex said, with and the conversations we're having with business owners and clients is, it's going to be tough going forward with the extra cost relation to national insurance. So, but then as you highlighted, Alex, trying to sometimes just because the economy isn't doing well doesn't necessarily mean that markets have to by default fall or do poorly as well. As Alex mentioned, actually over the last year since Labour came in, the FTSE 100, which is used as a gauge for the UK stock market, is up about 8.5%. So probably an average year. If you kind of looked at sentiment from clients and economic growth figures, and you probably wouldn't put those two numbers together. So I think it's a good reminder that we've been having conversations like this for for a few years now, really, going back to 2022, the outlook never felt positive, or at least it felt pretty negative, and yet markets do find a way to keep ticking along. So I think sometimes it's not to overreact to policy announcements. A lot's been announced, but it's some of them aren't coming in yet, and some might never come in. So it's kind of trying not to get too too leaning towards one direction of positive or negative. Really try and remain steady.
I think one of the things that I'd agree with you, Chris, entirely. I think one of the things that we've found, particularly with the budget and the spring statement, is brought back into how important it is to have some decent financial planning. So the changes with regards to business relief on companies, the changes with regards to agricultural property relief, the changes to tax on pensions. It's not just about return to try and maximise your assets. It's also about having some good tax planning in the background and looking at, first of all, protecting what you've got, and then using that as some strong foundations to take things forward. Would you agree?
Yeah, absolutely. I think as Alex mentioned, with the budget coming up, in the autumn, it feels like we're probably going to have a similar scenario to last time, where there's speculation and obviously the headlines come out of this is going to happen, that's going to happen, and I think it's just a case of you have to not panic and try and remain steady, because if you react to certain things, our job is to try and plan with the rules that we know, as opposed to second guessing what might come. And I think it's the same with investing at the end of the day. If we go back 3 months or so to April with Trump's Liberation Day, I think at that point again, it felt like, gosh, this is probably going to get worse from here. And Trump's just doesn't really care about the markets. He's just going to keep letting it go. And suddenly here we are, and markets are at all-time highs. And again, it was a period 3 months ago where it felt naturally, that it can only get worse from here. This is the time to, take less risk or to fully sell out. And it's a good reminder that, and it doesn't always come back as quickly as it has over the past 3 months, but, just sticking to the longer term plan and having a plan in place in the first place, I think is important, because if you've not got a plan for what the money's for, then you don't really know what you're reacting to or reacting for. So
long-term objectives, I suppose.
Absolutely.
Yeah. So just following off on that, Chris, you mentioned the FTSE's at an all-time high. Alex, the Nasdaq was also at an all-time high. The Euro stocks was all close to an all-time high, but hit all-time high back in April. The S&P, the Dow Jones, so it appears that everything's rosy in equities, but there's still, we mentioned tariffs before, and Brazil and what Trump was looking at doing. And we heavily concentrated that discussion at the last quarter. With regards to where we are with the tariffs in the US, do you want to just run us through where we're up to with tariffs, the impact that's having on the markets and portfolios?
Yeah, how long have we got? I mean, I think the last time we did a quarterly call was just after the 90-day pause, wasn't it? And we saw that big relief rally at the beginning of April was horrible for the US markets. It was tough in February and March as well. UK and Europe had a really good start to the year. But yeah, I mean, I've put some slides together on this because it's the main talking point at the moment is, what is going on with tariffs. So just let me share this with you. Excuse me a second. Is that working? No, I might have to go back a bit, sorry. All right, nearly there. Here we go. The tariff tracker. I mean, this is trying to encompass everything that has happened more recently. The first being the China increase in February. You can see March and April, the effective tariff rate just going up and up until April. And then this is the pause here, and that's when markets really bounced back and rallied. You can then see that there was a 90-day pause with China, which happened in May, so that's happened afterwards. More recently, as you said, there's been tariffs on individual commodities. Copper's just been discussed as well more recently. You've touched on Brazil. This morning there was more tariff announcements on Canada as well. So I think let's just skip through to the market impact. And apologies, you've seen some of these slides before, so I won't go through these again. This is the This is, to me, is the key one though. This is the impact to inflation and GDP growth on the US economy. So effectively, when full tariffs were announced, we were down here in this bottom right-hand corner, which was going to see inflation increase by about 3.5% and US GDP impacted by 2%. What Trump's done with the pauses is move us from that bottom right more towards that top left. So the impact is less and less. So that's giving investors confidence in terms of investing. But the US economy is struggling, and the US economy is struggling because confidence has been absolutely hammered. If you're trying to decide to build a new factory in the US and you don't know what the input prices are going to be, whether it be copper, whether it be steel, aluminium, etc., then you're just not going to do it. You're going to sit on your hands because things are changing all the time. I think it's a really important point as well, is that it's changing so quickly that you just can't plan for anything, whether that's businesses globally and companies in the US. And that's really causing uncertainty for consumers as well as businesses. And I think the thing that most people haven't realised, and maybe Donald Trump hasn't realised as well, it seems to be the biggest impact is on the US economy. So this chart on the left-hand side of the presentation shows US GDP was running around 3% last year. It's due to fall to grow at 1.5% this year. But look at the falls in other countries. I mean, China's a little bit of a negative there, but not really. UK and Eurozone, again, growing about 1%. So not stellar growth, but at least, it's not been impacted by as much. And what happened after Trump came in is there was a run on US assets. There was a run on US equities. There was a run on US bonds. And probably most notably, which people haven't appreciated, is there's been a massive run on the US dollar. Because effectively what Trump's done is upset the whole world, because tariffs have been put on every country. So every country has responded by selling US assets. And that's why this is a long-term chart of the dollar. When the line's going up, it's showing the dollar's appreciated. And you can see the big moves when Russia invaded the Ukraine there in 2021 and 2022 here. And it pushed the dollar up to very high levels. So at one point, sterling got to almost parity with the dollar, which feels like a lifetime ago, £1 to 106. Where we are today...
Which also had a huge impact on inflation as well.
It did, yeah, it did indeed. And then you can see here where we are today. We're at 137, and that's a massive move in the space of 3 years. And it's continued this year. So this is the year to date, the dollar versus sterling. So the dollar is down 10.7% this year. So that matters because when you're buying US assets, you've got to think about the currency that you're buying it in. And most of the time, when you're buying US equities, whether you're buying Apple, Microsoft, Tesla, Nvidia, etc., you're doing so when you're buying dollars. So you've lost 10% this year on the currency moves because of that. And I just wanted to highlight this. So you mentioned rightly so that the US markets are back to all-time highs. So this is the Nasdaq and the S&P moves this year. You can see, as I said, the market started off pretty strongly. It was probably mid-February when markets started to get whiffs of tariffs, and you can see how the US market behaved, fell significantly. You can see then when the 90-day pauses were announced, there's two big jumps. So the big one when we did the last webinar, which is obviously very well timed, was here. But then you've got the pause with China in mid-May here. And I think what we've got to now is a little bit where the market's just getting a little bit tired of Trump because it's constantly been announced and it's constantly getting rolled back. There's a new phrase called taco. I don't know if you guys have heard of this.
Yeah.
Trump always chickens out because he keeps rolling back on all these planned higher tariffs. And I think the market is just looking through it. We saw yesterday the FTSE hit an all-time high of just under 9,000, but it was on the day that more tariffs were announced. And it's just the market is just starting to look through it. So this is the returns for a dollar investor, and let's just remember those numbers: 6.2 and 8.2. But to a sterling investor, so this is putting those markets in sterling terms, you're still down. You're down 3% and you're down 1%. So that's a big move in 6 months that people have lost out for just currency moves. So look, there's one thing about what the equity market does and the bond market does. It's another also then thinking about what currencies are doing as well. And you go back to 6 months or so ago, it was a lot of excitement about when Trump coming in, and as a function of what's happened over the last 10, 15 years, US equities have dominated global stock markets now. And we've noticed it with some of our competitors that they've just rode that, they've just let their US allocation go up and up and up. We've been very disciplined with that and what we do. And we also thought the US was quite expensive, which is something that I've been talking about for a long time.
Yep.
I maybe have been right for the wrong reasons now because it's the currency that's gone down and not the stock market. But it's helped benefit us a little bit this year in terms of just being well diversified. 70% of the MSCI world is in the US stock market. The top 7 companies in the US, the Magnificent Seven, they're bigger than the other 7 countries outside of that. So next, and that's UK, Japan, Germany, etc. So massive countries, and those 7 companies are bigger than those countries put together. So it's been an interesting ride. But markets apart from that, let me just go through other markets. So this is just looking at the quarter. So you can see the big falls in April, the beginning of April from the market. You've seen the recovery. So the best performing market over the last quarter has been Japan. It's up nearly 11%. You've then got some pretty strong performance from UK and Europe, 4 or 5%. The Hang Seng's been down. So that Chinese stock market did have an extremely strong start to the year. And again, it's been a good quarter for bond markets as well. Depending if you're on governments or corporates, you made anywhere from 2 to 3% in a quarter in the bond market. So pretty decent returns. But if said to me right at the beginning of the quarter, you're going to have all this volatility, you're going to have all this uncertainty. Equity markets are going to deliver 4 or 5%, which is good for a quarter. The bond market's going to deliver 2 or 3%. I wouldn't have believed you because it's just staggering about the amount of volatility. We haven't even touched on Iran and Israel at the same time, and the spike that led into oil prices as well. So I think I've gone on for a little bit there about what tariffs. I think it was always going to be the longest debate because it's still going on.
So, Chris, with our clients, we always look and advise a well-diversified portfolio. Be if you're low risk down at a 3 or a high risk up at night, you should have a well-diversified spread of risk assets. So, and equities are just one of those. Do you just want to run through for any listeners out there, the alternatives such as structured products or Alex mentioned gilts?
Yeah, absolutely. I think often you get drawn to the headlights and the headlines of equity markets and what's happening there, but actually a lot of our clients will have a more balanced portfolio with the equities being the main driver of growth, but cash and fixed interest to diversify that. And that's where, again, in times like this, it's sometimes a good sense check to see how you felt with how your portfolio has reacted over the last 6 months, and if you've been kept up at night and it's been a bit too much for you, maybe that's an argument to tone down the risk a bit, and maybe you shouldn't have as much in equities and a bit more diversified into more low risk assets. But absolutely, there's despite cash rates coming down and in theory interest rates coming down, there's still opportunities out there. And I think if we go back 5 years or around COVID period when interest rates were effectively on the floor, now what we have actually is far healthier, and it means that if you are taking less risk, you're still getting paid for that. There was a time where you were nearly forced to invest in equities and have the bulk of your money there because that was the only way to get a real return above inflation. But at the moment, you can achieve that via fixed interest, structured products, as you touched on, Stuart. Volatility like this, the way they're priced, it effectively gives you better value on those types of products. So yeah, it's certainly, if you feel not as comfortable with what's going on in the world and what's happening in equity markets, doesn't mean you have to keep your money in cash. There's certainly ways to spread it around. And just touching on a point Alex made about the dollar and that impact, I think, I'm sure it's the same for you, Stuart, and I know some of the other advisors have been mentioning it. We're obviously having regular client meetings and they're seeing the headlines that, as we touched on, the FTSE 100's at all-time highs, the US markets are there, but client portfolios might still be slightly underwater compared to that February mark, and really that just is from that dollar movement, as Alex touched on. And I was having a good discussion with a client on Tuesday, Sue, who I know will be watching, and we were talking about obviously what's happened with the dollar in terms of it's obviously weakened versus the pound, but kind of I guess what are the potential drivers to then move that in either direction. And funnily enough, as you mentioned this morning, Alex, about the economic growth kind of coming in lower than expected, and one of the first moves of that was that actually the pound weakened against the dollar. But then there's, as I was speaking with Stuart about, there's lots of moving parts, and I guess if you touch on maybe some other things that moving forward might drive that currency in terms of interest rates and growth, because I think it's all good and well understanding what's happened, but then does that warrant a change in approach? I guess my argument would be no, because it's hard in the short term to really second guess where the currency will go. But it'd be good to touch maybe on what might actually drive that going forward.
Yeah,
I think it's the old adage, isn't it? Is it time in the markets, timing of the markets?
Yeah.
We'd always advocate time in the markets. And Alex, because obviously you head up the investment process, investment decisions at Luna. Do you just want to touch on how you make those decisions about what you buy, what you sell, going into the markets, coming out of the markets?
Yeah, so I'll do a Christmas and I'll come to that if that's okay. So I think the honest answer is, and I've spent 20 odd years looking for a currency fund that can deliver, and there's not, and it comes down to, because there's so many different factors with currencies. I've not found anyone who's very good at predicting what's going to happen with a currency. So apologies to Sue that I can't give you a clear answer, but you're right. I mean, the key drivers I see is economic growth, interest rates, but also it's politics. So let's just go through those three. So UK, I think, are going to cut interest rates quicker than they will in the US because economic growth's weaker, but also because of what's going on in the US being a stickier inflation. I mean, if anyone's not seen the spat between Jerome Powell and Donald Trump, that's worth looking at, because, I mean, to be honest, some of the stuff he says about them is truly awful. He says he's an idiot, he's behind the curve. This is the head of the biggest central bank in the world. It's just mind-boggling stuff. But they are seeing stickier inflation in the US and weaker growth. So, but it's inflation that concerns them most. The employment market's actually staying quite strong. So it looks like US rates are going to stay higher. And that matters for currencies, because if you can borrow or invest in a currency with a higher yield, a higher bond yield, then you'll do that, and you'll be more attracted to the dollar. So it's interesting that's not actually coming through. The second one I mentioned, economic growth. We've already touched on that. The UK and US are probably going to be broadly the same, 1 to 1.5% this year. But the US has tended to grow quicker than the UK. So the US has grown about 3% over the last 20 years, while the UK in good times grows about 2%. So that's why the US currency has done well historically. And then you come to the politics bit, and I'm going to answer that in a few ways. I think the first way is Trump's putting through this big, beautiful bill at the moment, but the US have got a massive amount of debt, more so than the UK. So let me just share this screen. Click through. Here we go. So this is global debt levels. The US is at the top there. So you can see the amount of debt that the US has. I mean, Europe is increasing and the UK is increasing, but the US is got far too much debt. They're running a massive current account deficit. And Trump's now introduced this big, beautiful bill, which is what he's been arguing with Elon Musk about, because that is going to be cutting taxes to the US, permanently cutting taxes to US citizens. Again, but where's that being funded from? I mean, the US, if this is, US can get away with it because of the global reserve currency. This is almost going back to what Liz Truss did. This is kind of the politics involved and what happened in the UK bond market when that happened. So that's having an impact as well. And then the final one from a geopolitical issue as well is when Russia invaded the Ukraine, the US made the decision to freeze or take them back, all the US Treasury assets that they had, just took them back off them, which, great move. But it's other people now are thinking, well, if we have a war or we do something, then the US are going to freeze our assets. So what emerging markets and developing nations have been doing is that they all have current account bond purchases, but they do and look after the finances. So they've been selling down their treasury holdings now, and they've been buying gold. So I don't know if you've seen the gold price over the last 18 months or so, but it's absolutely blown. Yeah, it's about 30% last year. It's about 25% this year as well already, because people have got governments of repositioning their reserves. And again, that's the trend that's not going away. You're just seeing the selling of US assets gradually. So I do think over the long term, I think the dollar's going to be weaker. And, I think at some point, and it's not now, and it might be in 10 years, it might be in 15 years, that the question about the US being the US dollar being the reserve currency of the world will come under question. At the moment, they're lucky because there's not really a real competitor to that. The euro is probably the next one, but the euro is not big enough. There's not enough traded in it on financial markets, etc. So we'll see. But I do think this could be a structurally weak period for the dollar. So
A good time to
link into
go on holiday to the US then, and
it is actually, yeah. I mean, like
get your Disney trip.
When I started my career, it was £1 was getting you $2.
Yeah.
And I remember people going to New York doing the Christmas shopping and things like that because it was so cheap to do it. So there is benefits to it. There absolutely is. And it's been expensive for us to go to the US for the last 10 years because of the exchange rate. Imagine when it got to 106 versus, that was particularly expensive. So back then, just looping it back to your point, Stuart, then, so how do we think about that from an investment decision perspective? So I mentioned earlier that when we're buying US equities, we're buying a dollar. We also buy US bonds. And what we've been doing for the last year is hedging that currency risk. So we're just getting US Treasury exposure and we're not getting exposure to the US dollar. We're not buying longer dated bonds because they're going to be more vulnerable as debt increases in the US, buying shorter dated bonds that are yielding 6%. That's a pretty decent return. And we've delivered 6% returns and pretty low risk because they're so short dated and they're maturing. So the first way is to protect is by currency, is by hedging. The second thing that we've done this year is reduce our exposure to the US. It's a tricky one because US market is expensive, but it's the dollar question as well that we're thinking about. But on the flip side, you're now seeing opportunities and things starting to turn around. We've been talking about how cheap the UK is, we're talking about how cheap Europe is for a long period of time, but now there's a catalyst for change, and I think Trump's almost caused that catalyst for change as well by forcing countries together. There's a Draghi report in Europe about trying to cut red tape and financial regulation across Europe to make Europe work better together as a bloc, which could be really significant. I've already touched about NATO 5% defence spending bill. Then with the 500 billion euros that Germany are going to spend, adds 1% to German GDP every year for the next five years. And when you think that Europe's only grown by 1%, that's a big boost to European growth, which should propel European equity markets as well within a stronger economy. And then the other thing is energy prices are going to start to come down. We do think that there'll be an end to the war in Russia-Ukraine. And again, back to Donald Trump again, can't seem to get away from him today. But that's the one positive I would say is more progress has been made in 4 months than 4 years under Donald Trump. I mean, we're still not there, but where might we be in another 4 months? And that has the potential of bringing more Russian gas online, more Russian oil online at some point when sanctions are lifted, etc. But that could bring down energy prices, which is massive for Europe with it being such a manufacturing-based economy. So there's opportunities still. European valuations are still pretty cheap. And this is the things that we talk about. So the Lunar Investment Committee meets on a monthly basis, but we all work in the same office. We can sit down and talk about things whenever we want. We have ad hoc chats all the time about tariffs, what's happened this morning, what's going to come this afternoon, what do we think is going to happen, what should we, is there anything we should be buying today? We had a structured product mature this week. What do we want to do with the proceeds? And we're constantly always talking outside of meetings as well. But I mean, structurally, we have that once a month meeting where we'll sit down and say, well, has this changed our view fundamentally on equities? Has this changed our view on interest rates and bonds? Do we like alternatives on the back of this as well and trying to reduce risk? Because that's the other point I'd make. You're starting to see bonds and equities perform a lot similar nowadays.
Yep.
So they sell off together, as you saw in 2022, but they rally together. And that creates a risk for portfolios because we want to be diversified and reduce risk as much as possible. So we are using alternatives probably more heavily within portfolios at the moment that can help soften the blow and dampen volatility within portfolios. But yeah, we look at all these things. We look at our dollar currency exposure in portfolios, our equity exposure, how much we've got mid and small cap, how much we've got in value versus growth, how much technology do we have. At the moment, we're underweight US, we're overweight Asia, Japan, UK, and emerging markets. So basically everywhere apart from the US.
Good. But I think you're right. I'm correct in saying there's probably a global restructuring of virtually every asset class and how the asset classes interact with each other. But Chris, that can create volatility. We were speaking before about reviewing risk and volatility, but volatility can actually work in your favour if you get it right, can't it?
Yeah.
For people listening to the portfolio.
Absolutely, yeah. I mean, for any clients who are still in the stage of accumulating and saving money, actually, volatility is not necessarily a bad thing. If you're buying every month, whether that's for your workplace pension or ISAs you've set up and things like that, you know, if you're buying at lower prices during these periods of volatility, it doesn't feel like it at the time, but then when the markets do bounce back, you've effectively got more for your money at that time. So, you know, it's easy to say just ignore what's going on when you're saving your money, but really it's not a bad thing, volatility, and it will help you in the long run. And it's effectively the price you pay for getting a higher return than cash, because you know, if it was simple and easy and straightforward, you know, you wouldn't get the extra return. There has to be a bit of a price to get that. And if you're, you know, on the later stage and starting to draw down on your funds, it doesn't mean that you should just completely remove volatility from your portfolios. I think, you know, we're seeing more and more, you know, that people are living longer. There's a lack of a, you know, proper social care system, and you know, people are going to have these pots of money or need these pots of money to last them 20, 30 years plus from when they actually might stop work. So it's easy to think, you know, as soon as I stop work, we just low risk and take all the volatility out. But in the long run, you're still going to need probably inflation beating returns to make sure that you can keep living how you want to live over the longer term. And that's where the planning comes in terms of, you know, it's not just as straightforward as let's just put as much money in as we can and kind of be at a higher risk level. It's more around the time horizon and having portfolio structured so that, you know, you've got that long-term growth pot, but you're not forced to cash in parts of it if the markets are down. And that's where, you know, the way that Pareto and Luna manage things in terms of that planning on the way out is about having a more of a bucket strategy where you've got your cash savings, and I talk about them every quarter. You know, having a nice healthy cash buffer is always important, but then having your you know, short to medium term funds that might be in a slightly less volatile portfolio, so that when you're drawing on those, you know, whatever Trump's doing isn't having as much impact. But certainly not just ignoring that you still need to have that long-term growth driver. So yeah, it's certainly it's one of those things, isn't it? We'll probably be sitting here for every quarter talking about things that could happen and have happened and the volatility, but you go back 5 years and think of all the things that have happened over the last 5 years, and it's been volatile throughout that whole period. Yet actually, there's been decent returns over the last 5 years. So it's trying to separate the fear of the volatility and accepting that that's part and parcel of it. And I think sometimes it's easy to focus on the portfolio side of things and the returns, but at the moment, you know, there's I guess probably more important things to be focusing on in terms of you know, with the changes that were made in the budget back in October. I think at the time when, you know, business relief as an example, you know, when they're speaking about April 2026, at that point it felt ages away, and now we're kind of, you know, beyond halfway through 2025, and suddenly it's, you know, 9 months till that point. I think now's a really good time, if you haven't been, to be engaging with the professionals that you work with your accountants, your solicitors, with us, because there's lots of organisation to be done, whether that's your wills, whether that's gifting strategies around your business,
restructuring of shares.
Exactly, and there's certain things that, you know, come April 2026, you know, if it's gifting shares into trust and things like that, where actually doing it before then is a benefit. So, you know, there's no time like now to really start sitting down and thinking, well, regardless of what's going on in the markets, am I structured efficiently actually for overall tax? Because often actually, if you get the tax right, that's going to probably outweigh a lot of smaller market movements depending on what portfolio you're in. So it really is.
There's a small window, isn't there, from now till April? So they've got 6 months.
Absolutely, yeah.
Restructuring individual clients, company share structure, and speak to the accountant, speak to your solicitor.
Yeah, and I think it's just, you know, it's basic housekeeping, things like wills. You know, you don't want, often it's not a nice discussion to start thinking and running through all these different potential scenarios, but you know, having them in place and relevant for the rules that are coming in is crucially important.
And also have a look at life cover, because that can be a huge, if you're looking at intergenerational planning, a small cost and premium per month can outweigh a large one-off lump sum, God forbid, when you pass away post 2026. April 2027 when pensions form part of your estate.
Absolutely. You know, what we're doing with all our clients at the moment is kind of looking at as things are now, and then how's that going to be different? And are the things that we could be doing now, are the things that we're lining up ready for when, you know, pensions come into the estate and things like that. So it really is, you know, it's an uncertain time in the world, but at the moment there's lots of change in just actual tax planning and things like that. So it really is important to be on top of those.
I think that emphasises the importance. But I'm not going to apologise for the plug on one of the services that we have at Pareto, but maybe look at cash flow planning, and we sit down with clients and we'll have a look at income and expenditure today, assets, liabilities, potential income expenditure needs, assets, liabilities, and we can model things through. But having those regular reviews are so important. Would you agree?
Absolutely, yeah. I think, you know, being able to visualize how your next 20 to 30 years might look is not only can it, you know, help with the planning and saying, well, this is what it looks like on the current rules, but this is how it's going to change and what we can do. But actually, in times like what we've seen in the last 6 months, when markets are down, if we can sit there and update your values with lower values and still say you're on track to do what you want to do, that can give clients the peace of mind that despite what's going on, even with Donald Trump doing all what he's doing, actually, I'm still going to get to where I want to. So, yeah, as you say, it's a bit of a plug, but it's something that, you know, I'm doing all the time with clients, and probably one of the most powerful things we can do with clients, I think, to just give them that peace of mind. So, you know, if that's something that you want a refresher on, then we can certainly, you know, look at that and get in touch with your advisor. But there's no time like now to really get reviewing things and get on top of this, because what you don't want to be doing, and I know chatting to some solicitors recently and they were saying back in October when the budget was coming, you know, they were scrambling around and they were getting people out of the blue saying, can you do this for me in a week? And it wasn't possible. And that's where, you know, you don't want to leave it till March next year and suddenly say, oh, I need to do my wills or I need to do this. And you end up doing it yourself because the professionals haven't got the capacity to do it. So, you know, really being on the front foot with that.
We do have that calculator, the IHT calculator that can help with that.
Yeah, we've got lots of tools and we've got lots of, obviously, you know, connections that we work with in terms of accountants and solicitors. So, you know, we can, as a team, you know, really get you in a secure and resilient position.
Unapologetic plug now for regular listeners. We don't usually go off track like that. So we know where we are in terms of the markets. We know what's caused it. Looking forward, Alex, and we haven't touched on geopolitical risk, such as we haven't touched on China. We haven't touched on the Israel-Palestine conflict, the Israel-Iran conflict, the Ukraine and Russia. The impact that Labour's going to have. I know we briefly touched on that. So going forward, what are the things that our listeners should be thinking of, should be wary of, should be cognitive of looking at if they are looking at investing some money?
Well, the biggest one I always say is timescale. You know, if you invest in equity markets, then you need to be thinking 5 to 10 years out. And if you do so, and you're thinking 5 to 10 years out now, that's weird to say that'd be after Trump now.
Well, assuming he doesn't find a way to cling on.
Exactly, potentially. But and looking at what the economy is going to do. So, you know, the global economy is forecast to grow by about 3 to 3.5% this year. It's not a bad year, to be honest. Inflation is going to be a bit higher, but it's not out of control. So that's not a pretty supportive environment to be invested in equities. Bond markets, again, we think interest rates. So the UK today we're at 4.25. We probably expect another 2 cuts this year, August and November. The Bank of England keeps saying gradual, so that's what once a quarter is how we interpret gradual. So it'll be 3.75 by the end of the year, and by the middle of next year, we'd expect to be kind of 3.25, 3 to 3.5. That's kind of the range you expect. So that's again pretty supportive for bond markets. But look, the reality is when you're investing, you can have shocks at any time. And, you know, who would have thought the pandemic was coming at the beginning of 2020 and we're locked down in March?
We've had 3 bear markets in effect since then, haven't we?
Yeah. So 2022, the US had one this year. But again, that's why we say it's important to invest for the long term. And Chris, you mentioned it really well earlier. We've had so many shocks over the last 10, 15 years, but yet markets are still at all-time high. I think that should give people some comfort in terms of investing, because companies adapt, companies change what they do. Inflation is actually a positive for companies to a certain extent as well, because it means they can increase prices and it increases their overall revenue, and the earnings per share go up as well. So,
and it can be for economies, because you can inflate your way out of
debt, can't you? Because your debt levels go and your economy's growing and GDP's increasing. So absolutely. And then the most important one when investing for the long term is valuations. Are you buying something when it's expensive? You go back to 2000 and the tech bubble. Everyone was buying everything when it was expensive. Everyone was so hyped up about what the internet was going to do, etc., that it was a really bad time to invest. And FTSE didn't go anywhere for 10 years or so. But today, you're buying at cheap valuations in most places. So the exception is the US. But the flip side for the US is they've got some of the fastest growing businesses that are delivering huge earnings growth, that have massive margins, that are sitting on huge piles of cash, that just keep delivering and delivering and delivering. So you can't ignore them. I said we've been reducing our US, but we can't ignore them because they've got some of the best businesses in the world there. But I think if you've got a good mix of different countries, different regions, different asset classes, when we started, we had interest rates at 0.5%. You could get gilts at 1% return for 10 years. Now we can get gilts at 4.5% returns for 10 years. The return outlook looking forward for me is a lot more favourable now than it was 5 years ago. So our kind of expected returns for the next 5 to 10 years are higher today than they were 5 years ago.
And I think that's we've reverted back to a bit more of the normal, because since 2008 up till COVID, that was the abnormality when interest rates were down at 0% or 0.25. It was free money to borrow.
Yeah.
And that was the abnormality, but we've got to get a generational thought process to change that. My daughter, 28 years old, she's got a mortgage rate. That interest rates are so high, and going, darling, they're not. That is the norm. I think the average Bank of England's interest rate is about 4.25 since the Bank of England started. So it's, the norm is now, isn't it? And sort of reverting back to a norm, but trying to get our mindset that this is the norm and that was the abnormality.
Yeah, I don't think we're going back to that ultra low interest rate period anytime soon. The only period we would do that is if there was a recession and there was deep concerns about the UK and the global economy, which doesn't look to be imminent right now. It's interesting you say interest rates are high. I remember speaking to my parents and my uncle about this. I think it was over Christmas, and they're talking about when interest rates in 1980. I can't remember what they got to.
They were 14-15%.
But yeah, exactly. Mortgage rates at 20% or something at the time. It's quite, we're not in that kind of world, are we? So,
but my ex-father-in-law, he was saying that mortgage rates were higher than what his net salary was at one point, because he had a place abroad and he had a place in the UK, and he was paying more in mortgages than what he was bringing in. So Alex, thank you. I mean, you mentioned about having a well-diversified portfolio, Chris. It's something that we would echo to all of our clients.
Absolutely. Yeah, 100%. What Alex has said, it's not trying to, just because the US has done well over a long time, you don't want to go solely in the US, but on the flip side, just because, the UK is not, it's all about balance in everything we do.
Well, as always, thank you for your insight. We do have a couple of questions. I think the first question might be Sue. We might have touched on it. The markets are back to some all-time highs. Why haven't portfolios risen as quickly?
Do you want to say that one?
Well, I think we've covered it off pretty well. I mean, the main reason is that currency impact. Effectively, if things are priced in dollars and the pound is stronger against the dollar, that's where, just when it's converted back, it means we're, despite the market being there in pounds, which is what we're investing in and what our clients are investing in, that's why it's still a bit below where we were. But as we touched on, it doesn't mean it's the time to second guess and change everything and rip the rule book up. It's trying to second guess where currency might go is difficult to do, but that'll be the main driver. And to be honest, when it works against you, it can feel frustrating. But 2022, as we saw on the graph, the US markets for US investors was down 20+%, both in their equities and their bonds. But as UK investors, because actually we were down at $1.06 to the pound, we only felt just about 10% of that. So it can work in our favour, as well as it's not always a drag like it has been over the last 6 months.
Yeah, no, I mean, we touched on it. The reasons are currency, and because the US market's done so well, that it's become a very big position in some portfolios for some of our competitors.
I think it's also worth bearing in mind that we're not 100% invested in a tracker within the FTSE or a tracker within the Nasdaq. We are diversified, going back to, I think that's the theme of the webinar today, and going back to 2021, pre-2021, there was 0% interest rates and you get 0% return in cash. I remember when equity markets were down and you're getting 5.5% in cash, and everyone's going, well, why don't I put everything into cash? So there's those swings and roundabouts. If you react to the market, then sometimes it can be bad. You mentioned gold before. You know, gold was all-time lows for years and years. People weren't investing in it. Now it's 30%, 20% returns. So secondly, with regards to, we haven't mentioned China and obviously the importance of China as the second largest economy in the world. I don't know if you just want to touch on the importance of China.
Yeah, I think the big thing that's happened recently is just the US-China trade deal. You didn't want that rumbling on. It looks like they're working towards an agreement. I think they both realise how important they are to each other. So I think that's the key positive. You're not seeing any geopolitical issues with China at the moment, Taiwan being the obvious example of that. That always seems to be on the back of my mind. Is there anything going to happen there?
I don't think that'll ever get resolved.
I don't think so.
In the short term, anyway.
Exactly. So that's always a risk with China, is what happens there. And we saw, when Russia did that to the Ukraine, Russian assets everywhere globally were stopped. Russian equity markets were frozen and written down to zero. Russian bonds were written down to zero. So if you've got any exposure there, you need to be mindful that could happen.
Yeah.
Chinese economy is actually doing a bit better. So the last 3 or 4 years, they've been dealing with this property overbuild. They've had cities which have been empty. They're now tackling that problem. But as we saw in 2007, 2008, it takes a while for you to work through a housing crisis, and that's what's happening in China. But they seem to be doing it. The other important point is I think it's underappreciated how far ahead China are in terms of technology. Whether that be cars, I mean, they will be exporting more cars globally than any other country soon, with the electric vehicles that are going out, which have got better technology. I mean, there's obviously a concern there about what is it being used for any reasons that it shouldn't be. But if you take it on face value, then the technology looks fantastic. They just opened a BYD garage in Greater Manchester, Stockport. So I can that's happened. DeepSeek was another good example about artificial intelligence, but not just artificial intelligence, but doing so at a very lower price point as well in terms of what they actually were able to deliver. So that to me, it gives opportunities in China, and then because
they still don't have the super processors that Nvidia have, haven't they? That's one of the saving.
Sure.
Well,
yeah. Then back to the other point I was going to make is that Chinese equities have been unloved for 4 years because of what the problems they've had in the property market. They did so well at the beginning of COVID as well. They were a bit expensive. They devalued significantly. So Chinese equities look pretty cheap. So to us, we actually, via the Asian funds that we buy, we've got some exposure to China, and it's done well this year. I mean, it's not done well the last quarter because of the tariff concern, but China got off to a roaring start in the first 3 months of the year. But we see this opportunity still there. So again, it's just another. It comes with more volatility because of the fact that you could see them come through and start impacting individual sectors, what that technology or education. The government come through and did that a few years ago. So there's definitely more risk there, as well as geopolitics. So we'll have an exposure, but it will never be 50% of a portfolio. It's going to be contained appropriately.
Good. Anything to add, Chris?
No, I think what everything.
And then the last question that's in is around AI, and is the strength of the markets based upon the potential of AI going forward?
Yeah, I mean, you saw this week Nvidia became the first 4 trillion company in terms of market cap, which gives you an idea about the potential growth of AI, and it's not going away. I mean, it still feels like it's in its infancy for us when we use ChatGPT. I've got the new Apple phone, and it's all linked in, and it's pretty cool, to be honest. But it's still in that kind of adoption stage. And that build up of hardware is that kind of first stage of AI, and that's why Nvidia is doing so well, and other tech semiconductor companies are doing well on the back of it. The next stage is what companies use it and benefit from it the most, and how can we be more efficient with what we do. We're not at that stage yet. I think that will be the next few years of what we do, but it's not going away, and if anything, it's going to get more and more intense. And then the other important point is the data usage of these things and the electrical powers. So it doesn't, at the moment, it's the AI chips that are doing well. Next, it'll be the software and applications that do well. But the amount of data rollout and electricity usage that comes with, that's going to have impacts further down on different industries as well. So we're still positive on it, and think it's going to be a long-term grower. But we want to do it in a diversified way. We're not just going to put everything in video and with it, because whilst it's up 25% this quarter, it was down 30%, and it's just again just understanding that market volatility.
I think AI, not just on Nvidia and the US Magnificent Seven, AI will have an impact on all companies. So we should see growth within all companies.
Absolutely, yeah. You know, we're trialing things at the moment to improve efficiency, and I think that's the key. Where for a few years, especially in the UK, it's felt like where's growth going to come from? But if we can become more productive with the same level of input, I think that can hopefully pick up some of the slack. I think you saw, especially from 2008, from the financial crisis, that kind of productivity dipped and never came back, and so it seems that AI will probably be the thing to gear that up again. But the hard thing is there'll be sectors that win, sectors that lose, and it's adapting to it, and it will be a new world. It always is, but it's just making sure that you know what you're doing with it, and but getting the best out of it. So
well, again, thank you all for your time today, and Alex and Chris for your insight as always.
Yeah, thank you.
The next quarterly investments webinar is due on I think it's the 15th of October, but with the Labour announcement later on in the autumn, we may look to rearrange that until we've heard Rachel Reeves's changes to finances and legislation. If there's anything that anyone listening to would like to cover for us to cover in the future, please feel free to let your advisor know or send an email into marketing@Pareto. Feel free to speak to your Pareto advisor, again, stressing what we've been discussing today about a well-diversified portfolio, making sure it reflects your risk, appetite and volatility. Please get that checked out. There is a short window of opportunity for the changes that Rachel Reeves has mentioned about BR coming in. So I reiterate what Chris was saying before: sit down with your professional advisors, your accountants, your solicitors, your financial advisors, and have a full review. And if there's anything we can do, we will assist where possible. So thank you for your time today. Off to get my bucket hat on, and I might see everyone at Heaton Park later.
Thanks, everyone.
Thank you.
Cheers.